Good morning, market scholars, and welcome to your question and answer session for Thursday, November 21st, 2019. I'm your host, Brandon Van Zee. Oh, what a morning! Um, if you haven't heard by now, maybe you're living under a rock, but most people have heard already in the last couple of hours. Big news that affects all of us, at least that's my assumption. Most of you probably are involved with either Schwab or Ameritrade or both. But it sounds like there's a major merger in the works here this morning, and it looks like the stock market fully believes that the deal will get done as well, considering the stocks are flying higher. And I would guess that that Schwab would not have gone forward with kind of letting this information out if they had not already gotten a fairly strong sense that they could attain ownership of TD Ameritrade from TD Bank. Remember, that's really the most important party in this whole matter. TD Bank up in Canada owns 42% of TD Ameritrade. So unless they approve of something, the deal's not going to get done. So my assumption is they kind of talked it over and got comfortable with the idea of letting go of TD Ameritrade. So what will happen going forward will be anybody's guess. It's going to be quite interesting. I actually was texting with one of my buddies back in Omaha. He's a branch manager for Schwab there, and this morning was the first he had heard of it. And so they kept it pretty tight-lipped, I should say, not just from the TD Ameritrade side, but also on the Schwab side of the equation. So anyway, it might very well affect us here as investors and traders. Of course, we use the Thinkorswim platform a lot in our classes, and I just happen to use it a lot just personally, from an investing and trading perspective. And so my greatest fear out of the whole thing is that the bigger company, in this case Schwab is bigger than TD Ameritrade, decides that they're the more powerful force in this merger, and they call all the shots and decide to basically extract all of the clients from TD Ameritrade and then throw away everything else. I really, really hope they don't do that because the Thinkorswim platform is incredible. It's amazing, and from my perspective, it's more powerful than the tools they have over at Schwab. So I hope they come to their senses when they have that conversation and make sure that they keep the best tools of the combined company going forward, in addition to combining the asset bases, which is what they are really hoping to accomplish because of scale issues. Of course, what is causing all of this is what we discussed in this class a couple of months ago, which is the brokerage industry just went to zero commission. So it's really interesting to see how it unfolded, with Schwab kind of throwing down the gauntlet and going to zero commissions the very next day, or it might have even been that afternoon. TD Ameritrade responded nearly immediately by saying, oh yeah, I guess we're going to have to go to zero commissions as well. And so it's almost interesting to think that Schwab may not have known what they were doing at the time. I think Schwab knew they had an upper hand in the situation, that they could go to zero, whereas other brokers would struggle more just because of how their revenue base was developed. But I don't know if they knew that by the end of the year, they were going to be taking out one of their biggest rivals as a result directly of that particular decision they made to go to zero commission. So it's really, really interesting to see how all of this is shaking out. And of course, we in this class might be joyous for another reason. Of course, we were fortunate enough to buy TD Ameritrade stock when it was trading in the mid-30s after it got absolutely annihilated. When they made the zero commission decision, the stock went down dramatically. It was down like 25% in one day. And by the time we got into class later that week, we were able to get it at an excellent discount. There were people that suggested I shouldn't be looking at TD Ameritrade as a stock for long-term investors. And, maybe they would say, looking back now, that I just got lucky, perhaps, but you do have to be in it to win it. And mergers and buyouts do happen. And so that one stock in our portfolio, TD Ameritrade here today, is really boosting things for us across the board. So I'm from an investing perspective, I'm thankful that it shook out the way that it was. I'm just kind of it's just very interesting to me from the strategic side of the equation. But from an investing perspective, it worked out great. Schwab, threw down the gauntlet. TD Ameritrade responded with zero commissions. TD Ameritrade's stock price got absolutely annihilated. we've picked up high quality merchandise on the cheap, which is always our battle cry as dividend growth investors. And now we are the beneficiaries of a move right back up as TD Ameritrade is likely to be bought out. So anyway, very interesting morning. Some mornings I kind of struggle to get out of bed. Other mornings I pop right up. Today was one of those mornings I popped right up because I had text messages from a bunch of friends that were saying, just see the news. And I'm like, no, this is not happening. This is crazy. Like Eva was saying on Twitter this morning, she said, yeah, you predicted that there would be M&A activity in the brokerage space when I asked you that question a couple of months ago. And that's true. I did predict it. But I said, I have to be honest with you, this was not the merger I was expecting. I was expecting TD Ameritrade to buy E-Trade and for them to bolster their services up to compete against Schwab, against Fidelity, and against Vanguard. I was not anticipating Schwab to be buying out TD Ameritrade. So anyway, it makes sense, considering the situation and, where they're going to need to search for new revenues going forward, et cetera. So the merger does make sense. It just kind of came as a little bit of a shock to the system, considering the heft of the deal. In a lot of other industries, they don't allow the biggest players to get together very often because there's fears of potential, monopolies or different things like that. But this is a little bit of a different ballgame here, where you have not only discount brokers, but you also have full service brokers that are out there still, like Morgan Stanley and the like. And then you have a lot of up and comers like Robinhood and those types of new apps that are out there as well. So, I kind of get the sense that normally when you see a merger this big, I have hesitations around whether it would actually be allowed by the Justice Department or not. I do get the sense they're going to be able to push this thing through if they really want to. So anyway, brace yourself for change in the future. It very well may affect all of us, not only from where our assets are held as individual investors, but also how we go forward with doing our research and navigation and different things like that. Since so many of us have a long history of using TD Ameritrade's resources, we might have to get more comfortable with Schwab's resources at some point in the future. All right, so as a reminder, everything we discuss is for educational purposes only. Reminder that everything that we do here in our classes is just for education. We cannot give you individual advice, right? We're not going to be here telling you that you have to buy this stock or you have to sell that stock. We give you ideas, we give you thoughts, and we're hopeful that you're taking that information, becoming more well-educated, and hopefully becoming more confident in the process. And you'll never be perfect, no matter how educated you are, but hopefully after you become educated, you're making more good decisions than bad decisions. Remember, you do not have to bat 1,000 in this business. As long as you get more decisions right than wrong, you stand a good chance of being successful as an investor. So that should always be kind of the go-forward policy for you. It's make sure your expectations are kept in check there. If you have any questions on your responsibilities as an investor or your expectations during the classes or different things like that, make sure you check out our terms of service on our website for additional information. All right, so what's the goal of this particular session? Of course, it's a Q&A session. We put the end of our week so that way we can circle back and kind of discuss topics that we haven't been able to dive head first into in our classes earlier this week. Some of you might also ask me investing or trade ideas. The one thing that I do ask you to do in response is make sure that whatever question you're asking me is within my circle of competence. If you don't know what that might be, just seek out whatever I'm teaching in my classes. Those are the types of conversations I can have. Beyond that, then it's anybody's guess whether I have a way of giving you a halfway intelligent answer or not. All right, real quick on some of the housekeeping items here. Remember, one question per student just due to time constraints there. Remember, this particular class is only for premium members of Market Scholars. Plus, subscribers are not invited to this particular class. We have a little bit more freedom with the things we can talk about and look at during class and things like that. But we still have a healthy amount of people that attend here. So just got to make sure that we're trying to keep it somewhat fair for everybody. So one question per student. If you do have a question for me, seek out the question and answer panel. Remember, that is different than the chat panel. We open that up for these specific Q&A sessions here. And then also down there in the yellow font, it's also helpful if you can start your question by typing your name first and then immediately typing out your question. That allows me to quickly copy over your name and your question to my notepad, so that way we kind of know where we stand with the order of questions that are coming in. Thanks in advance. All right, let's go ahead, share the desktop, and get going here with the session. All right. Give me just a moment to get my other monitor all established. There we go. And it's kind of interesting. I was looking at the paper money account this morning because I was curious how TD Ameritrade would affect our portfolio. And it's interesting because as you look at the mark percentage column here for the DGI account, we have way more losing positions here today. Yet we're up $1,700 today because of what you're looking at right there. TD Ameritrade, a big winner for us. Ends up at this point being the biggest winner of our portfolio so far since we've been cobbling this together since the beginning of July. It's up 38% now since we were brave enough to have purchased the shares just on October 1st, really a month and a half ago, a 38% return. We'll take that anytime we can get it. All right, we've got a couple questions coming in already. Let's go ahead and start with Eva's question. And Eva says, BAC, so Bank of America, and BCS, Barclays, downgraded ED, long at 61.90, would add to ED or any champion on significant dips if they fit the DGI parameters, even though you yourself don't add. Would Value Line or Morningstar shed any light on the downgrades, or are they too dated? Yeah, so let's take a look. ED is an excellent dividend growth investing company. Some of you might be surprised to learn, depending upon your history as dividend growth investors, that Con Ed is actually the only utility stock in the Dividend Aristocrat list. I mean, that sounds like it's untrue, but that is the case. There are a number of utilities that have more than 15 years of dividend increases. But 25 years was hard for many of them because of what happened during the Enron era, where many of the regulated utilities tried to get a little too cute with their business model and go into non-regulated businesses and ultimately learned the hard way that that was probably a poor decision. Many of them had to cut their dividends. So many of them started rebuilding their dividend policy since the Enron debacle. But Con Ed was one of the few that was able to kind of stay the course, so to speak, even through that era and continue to raise dividends. So without a doubt, Con Ed deserves consideration from a dividend growth investor's perspective. The problem is the market has recognized how elite that company is over the years, and we would need a dramatic pullback in price before we could get excited about it. Here is Con Ed. And you can see that this stock has basically erupted in recent years as interest rates have plunged lower and lower and lower. Most of you by now are aware that when interest rates go down, utilities and REITs tend to go up, and that is kind of the general flow of things over the most recent years. And so where we sit right now with Con Ed is what we would consider in the class to be overvalued territory. Up here in the orange is where we want to be more hesitant around our choices. Down here in the blue is where we want to be, thinking about purchasing stocks, right? And by the way, this comes to mind as well because Target, of course, was in the news yesterday, another big winner for our portfolios over time. It caught my eye that not only did Target end up doubling our money for those of us that were buying in the low 60s and high 50s over time, but it also, for the very first time since going all the way back to 2013, Target is now in this overbought territory here, or overvalued territory, specifically from a yield perspective. So, some of you try to kind of trade around your core positions and different things like that. When I teach dividend growth investing, it's meant to be a buy and hold philosophy, but I do get a lot of you asking me, okay, so when do we buy, when do we sell? And, if I want to recycle cash, how would I go about that process? Well, Target, now that it's in the upper reversal zone here, not upper reversal zone, it's the you can consider it the overvalued territory from a dividend perspective. This might be an area where you start selling some calls on Target, or those of you that are convinced that you need to free up cash to support purchases of other stocks, maybe you consider selling some of your Target. The point that I'm making is not that I'm encouraging you to do that because I would rather encourage you to be a buy and hold investor. But for those of you that have asked me that question many times in the past, this is the type of scenario where Target has blasted higher. It's now up here in the orange. It now has a weekly cluster up here. There are signs that suggest that, hey, you know what? We've had a good run of things. It's possible it's time to maybe take a little bit of profits there, or sell some calls or do some bearish thing there, if that is your prerogative. Again, that's not what I teach in my classes, but many of you like to do that nonetheless, so I thought I would mention it. So that's where we find ourselves with Con Ed as well, which is Con Ed, is a great company, and it's an interesting one that I would love to add to the class portfolio, but this is not a big enough dip for us. So Eva mentioned, buying on the dips and kind of legging into a position, and there's nothing wrong with that at all. As she mentioned in her chat, I don't personally do that, but it doesn't mean that is like right versus wrong. I am somebody who's kind of like wants to make one decision, either get in or get out, and live with that decision. Other people like to leg into their positions. There's nothing wrong with that as well, as long as they ultimately don't over allocate to one single stock in their portfolio, because some people get caught up in a disturbing trend of, when a stock pulls back, they buy some. When it pulls back more, they buy some more. When it pulls back even more, they buy even more. It pulls back more, they buy more. And then they wake up one day and they realize that 40% of their portfolio is in one stock. And if that one stock ends up being Lehman Brothers or General Motors, you are done for. So I just don't always trust myself when it comes to that sort of a scenario. So that's why I make the decision to buy once. And if I'm right, great, I will benefit from that. If I'm not right, well, it's not going to destroy my whole portfolio. So to each their own on that count, but there are plenty of successful investors that do buy from a legging in perspective. So even if that is your philosophy, there's nothing wrong with doing that whatsoever, as long as you're committed to not overdoing it from an allocation perspective. But this pullback right here just simply is not strong enough. We need this thing to come down dramatically in order to get to more attractive levels. The average high yield on this one is 4.8%, and the stock is only yielding 3.4% right now. Now, if we were to look at value line like she suggested, let's go ahead and pull up ED, Con Ed. Always love watching the old Ghostbuster movies and seeing Con Ed in the background, as a big part of the movie. Of course, a big utility company there in New York City. So Con Ed, as you can see, is considered a safety score of 1, which is great. That's what we're looking for, right? So again, this is the breed of company we are looking for as long-term investors. So, when you hear me say our battle cry is buy high-quality merchandise on the cheap, I consider Con Ed high-quality merchandise. My problem with that equation right now is I do not consider it to be on the cheap. In fact, you will see that that value line effectively agrees with my mindset there. But of course, you'll have to remember that value line and Brandon can both be wrong. But the reason I say that is you'll see here that value line has a range of their expected prices out to 2022 to 2024. They expect Con Ed to be trading somewhere between $80 and $100 in that time period. Well, that's pretty awful because as you can see, the stock is already trading at $88. In other words, they think that if you held this stock for 5 years, there's a pretty decent chance you would actually lose money by holding this stock in the next 5 years from where it is right now. Now, again, Eva's situation is different because she was buying some in the 60s where she should have been. So that's great, and that kind of averages her cost basis to a degree. But for people that are buying right now, whether you're legging into it or whether you're just buying for the very first time, do understand that there are people that believe, or in this case, an organization like Value Line that believes you would stand a good chance of losing money in the next 5 years, right? And that can happen to any stock. Let's be honest. Like if we go into a bear market, most stocks would be down in that bear market time period. And if it was 5 years from now that we were in a bear market, a lot of stocks would be down during that period. But Value Line doesn't make that assumption when they are doing their price targets here. They are just basically looking at history as a guide to determine what is the proper valuation of the company they are researching and what is their earnings expectation going forward to help support any price per share. And so anyway, they tend to think that this one's a bit overdone to the upside. And you can see that it's a stock that, if you were to look at the yields down below, I kind of briefly mentioned it a moment ago, that we were a long ways away from viewing this as attractive from a dividend yield perspective where it currently sits. Some of you might be thinking, well, isn't 3.4%, isn't that a high yield, Brandon? Well, it's high compared to the S&P 500, but it's most definitely not high compared to Con Ed. People forget these utilities and REITs once upon a time used to yield 5, 6, 7, 8% regularly. It wasn't like out of the ordinary like we would view it here today. And Con Ed kind of represents that conversation, because you can see here that in all of the years back here, from 2003 to 2010, except for 2007, all of those years, it was yielding at least 5%. So when you're looking at a current yield of 3.4% after a bit of a pullback, it still isn't enough. We're not even remotely close to some of those historical yields where we really like to take advantage of those opportunities. So that is the biggest issue I have with Con Ed, and whether that ultimately is a strong enough warning sign or not is anybody's guess. What's really going to solve for this problem is what happens with interest rates, right? If interest rates keep on falling, it is possible that Con Ed and other utilities and REITs just keep on going about their meandering higher in price and they're meandering lower in yield. So a big part of this conversation is from a macro perspective, what are your expectations? If you think that interest rates are going to go up in the future, I would be quite hesitant in adding Con Ed right here as a result of what I see here from a stock that offers a very unappealing yield and a stock that is expected by a value line to potentially go down in price in the next 5 years. If, on the other hand, interest rates go lower in the coming years, then I could see where this current state of affairs could be maintained. So, that's a really big kind of critical question you need to ask yourself there. And I don't know the answer. Nobody does. Nobody can predict interest rates any better than they can predict where a stock is going to be. But if you have a set of assumptions you're working with, and that can help you make a decision for your portfolio as well. One thing that I would say specifically to Eva, because I've been around her, I've had the fortune of working with her for a number of years at this point. She's somebody who's done really well with REITs, and that's great for her. But it's important to this conversation because REITs and utilities are so similar to one another that if she does have a big allocation to REITs currently, then she might hesitate a bit more in adding additional utilities compared to somebody else who might feel a little bit more desperate that doesn't have a lot of REITs and utilities. They might have to kind of make borderline decisions on purchasing at the wrong times because they just need to fill an allocation. But for Eva, I'm guessing she's probably got an over allocation towards REITs, and therefore she doesn't need to be desperate when pushing money into utilities and REITs going forward, unless she has a very strong sense that interest rates are going to continue to go lower from this point forward. So anyway, those are some of the key areas that I would concentrate my efforts on there, Eva. In terms of Morningstar, you asked me to look at that as well. Let's go ahead and pop that up and just kind of get a sense of what they're looking at over there. I'm guessing that Morningstar is going to give them a narrow economic moat and would likely not be too keen on their star ranking, but let's just see if I'm wrong with my assumptions. Okay, so here we go. And yeah, it looks like Morningstar agrees with me as well, which is they only award them a 2-star ranking. Remember, their rankings go from 1 star to 5 stars, so this would be considered below average. In other words, not attractive to be purchasing at this current price. You can see, actually, they don't have a moat. That's even more surprising to me. Most utilities in the Morningstar universe has a narrow economic moat. The exception to that is Dominion, which is a stock we currently own in our DGI portfolio. But most other utilities have a narrow economic moat. It's interesting that Morningstar suggests that Con Ed does not have an economic moat. So out of curiosity, let's just take a look at why they would state that. It says, we give Con Ed a no moat rating. Regulation for some U.S. distribution utilities supports economic moats given the implicit agreement to maintain a refund or a return of and on capital for investors in utility infrastructure. However, regulators in New York provide returns on equity of only about 9%, below the industry average that is currently between 9.5 and 10% in other states and federal jurisdictions. This results in returns on invested capital that are marginally above our estimate of the company's cost of capital. So, it sounds like they are not quite as generous from a regulator perspective in New York compared to other states, and are not willing to award big return opportunities to the utilities that do business there. So that is the reason that Morningstar is not willing to give them an economic moat rating there. So, be aware of that as well. And again, I will stress, Morningstar can be wrong, I can be wrong, and Value Line can be wrong. So if you want to carve out your own path and, load up the boat with more Con Ed, nothing's going to hold you back from doing that. Just, my job is to be objective and to let you know what I see in front of me. And for each one of you, you take that information, digest it along with all the other research that you're doing on your own, then try to make a determination there for yourself. But, again, I would stress that if we come over here to, let's just do a 2-grid in this case, and look at XLU and VNQ, and take a look at a 5-year chart here, you will see that real estate has gone up over this last little time period, and utilities have gone up over this last little time period as well. I would put in, some of you are wondering, why wouldn't you put in XLRE? The reason for not always using XLRE as much as I use the Vanguard ETF is XLRE was just created more recently. It doesn't have a long history. In fact, it was only created back here in 2015. So it doesn't even have a full 5-year history here. But, hopefully those of you that, understand the concept of interest rate sensitivity clearly see a pattern here that these two charts look nearly identical. Whether you're looking at utilities and REITs, and you understand that the market views them as very similar to one another, even if you guys don't always agree with that concept or philosophy. Hopefully you at least recognize that others do believe in that concept and philosophy, and that's how those securities will trade. So if you expect interest rates to continue to go down in future years, it would make sense that you would also expect XLU and XLRE to continue to go up on a relative basis. On the other hand, if you thought interest rates were already way too low and too close to zero, and they're due for a bounce, then I would anticipate that these two areas will start underperforming the market. In fact, we've already started seeing that, right? And underperformance is not something that we fear in the short term as dividend growth investors. In fact, we look forward to it in order to look for opportunities. The problem is this is such an overinflated bubble in the case of both the utilities and the REITs that there could be some, really bloody downside action in the future if interest rates did go up at a fairly steady pace. And so many of these are priced way outside the bands of their normal range of valuation. And in order for them to get back into their normal range of valuation, there would have to be a really big drop in these types of securities. So whether that happens or not is anybody's guess. People have been kind of waiting for that for many years at this point, as they kept on saying that interest rates could never go lower. And yet what has happened? Interest rates have continued to go lower, and these types of securities have continued to do well. So again, a lot of what you do with your portfolio may be hinged on what your expectation of interest rates are going forward. All right, let's go ahead and now take a peek at our next question there coming in. And this one comes in from Claire, and she's asking, awesome new charts. Can we please look at HPQ's business model as a dividend growth investing candidate? It's kind of interesting you bring that up, Claire, because that was, I was borderline going to look at that one here in the last couple of weeks. Now, HPQ has been in the news due to a potential merger of its own. We talked about the merger of TD Ameritrade and Schwab already this morning. Well, don't forget that there are other mergers taking place out there. Tiffany has been a big winner for some of us as part of their merger with a big conglomerate over in France. And, there are other mergers taking place such as HPQ and Xerox. We don't talk about that one quite as much, but it is a fairly important deal as well. So let's go ahead and take a look at where things stand here currently with HPQ. And you'll see that this stock has bounced higher here in recent weeks after that story has emerged. Now you'll notice where things stand right now is HPQ is viewed as in an attractive level from a dividend investor's perspective, right? And again, that's only one way to look at stocks, and so that's our approach in our Tuesday class. But for those of you that have other approaches from technical analysis or different valuation measurements, do whatever makes you successful. But from the one approach that we use in our class, this would be worthy of consideration, which is why I mentioned a moment ago that I was halfway thinking about bringing this up for an official head-to-head matchup in one of our classes in recent weeks. Haven't decided to do it yet because I kind of go back and forth on it. I don't know how enthusiastic I actually am about HPQ as a business, but it is kind of interesting that Xerox wants a piece of the action there. So there are pieces of HPQ that I suppose may have a little bit of appeal out there, and it could represent an interesting kind of speculative idea that if you're buying it now based off of undervaluation, you might kind of have an ace up your sleeve with the possibility of a buyout taking place as well. You can see that this stock went all the way up here to, let's call it close to 22 on the day that potential buyout was being announced, and now it's all the way back down here below 20. So, right now that could tell you that maybe the deal is less likely to get done. So that's the stock market telling you that by sending the stock back lower. But maybe they just need to button up a few things behind closed doors with the two management teams of HPQ and Xerox. And as long as they can, button up a couple things here and there, maybe HPQ would be more willing to let themselves get bought out. And if that's the case, maybe there's a quick $2 per share move in front of you. So, we don't buy stocks from a long-term investor perspective in dividend growth investing with the priority reason of buying it being a potential buyout. But it's just one more thing to consider. And like what happened with us with Ameritrade, right? Ameritrade, that stock chart looks ridiculous here today. Boom, all the way to the upside. That can really benefit you. So we don't buy stocks because we think they're going to get bought out in dividend growth investing world. But if that's a realistic possibility, we're not going to fight that at the same time, right? Generally, when a stock gets bought out, it's a takeover, not a take under. Every so often, you'll see a stock that actually goes lower on a buyout announcement. But I would say probably 90% of the announcements that take place, the company that's being bought out, their share price goes higher. So always a nice little kicker right there. All right, let's go ahead and take a look at HPQ over here on the spreadsheet. Give me a second to pull that up. There we go. Okay, so as we look at the spreadsheet, let's go ahead and pull up HPQ here, add it to the current selection there, and let me get rid of those other two that I just use as placeholders. There we go. And you can see it's got 9 years in a row of dividend increases. So it's okay. Again, I have mixed feelings about its business model. Like if you're asking me about big tech dividend paying companies in general, I obviously like the business models of companies that we've purchased in the past, like Microsoft, like Texas Instruments, like Qualcomm. That's the type of company that I would prefer over HPQ. But because it has 9 years in a row, it's a possibility for us to at least review here in class. Remember, our rule in our class is to look for 5 years in a row of dividend growth or more. So, again, I have to admit, my mindset about Hewlett-Packard is just not that great. And, apologies to any of you that have ever worked for the company or anything like that, because I'm not trying to be disrespectful towards the company. I think in terms of being an investor, and I just don't know how excited I get about being the owner of Hewlett-Packard. Once upon a time when I was in college, I actually worked for Gateway Computer. Some of you might recall that company. They were the company that back in the 90s, they would send out their computers that they oftentimes sold through catalogs. And when you received your computer, they came in a big spotted box that looked like a milk cow. That was their shtick, because that company was headquartered in Sioux City, Iowa. They had a little bit of offices in South Dakota as well because of some of the tax breaks they could get there. But anyway, where I went to college was less than a half an hour away from where the headquarters were for Gateway Computer. And so I actually worked for them in their call center as a college job one summer, and kind of got to know some of that business. And Hewlett Packard was certainly a force in the business back then, but I've kind of watched their brand deteriorate over time. And they really are kind of a shell of their former self, I think, in the psyche of consumers that are out there. Maybe I'm wrong on that. Again, a lot of you are more well-versed in the technology world than I am, but that's just kind of my impression, that it's kind of an old has-been type of a brand now. It doesn't have the same appeal that it once did from an investor perspective. However, it does have a very attractive yield, over 3%. Its most recent increase was over 15%, so that's pretty impressive, right? We love them over 10%. This is considerably over 10%. You can see that the 5 and 10-year numbers are outstanding as well, right? So if this is a company that can continue at those rates, even if you're not like truly enthusiastic about the business, if you're starting with a yield of over 3% and you think that dividend is safe, and they're going to grow that dividend in the future at mid-teens percentages, there's a better chance than not you would have a good outcome with that situation, right? Again, it's not me, saying that, we should all go out and buy Hewlett Packard, because again, I have personal hesitations around the business. But I will just say that if my thoughts, my reservations around the business are proven incorrect, the numbers themselves look quite attractive. The payout ratio is only 23%. That's amazing, right? There's plenty of room for boosting that dividend through the current profit stream, let alone if they were to grow profits in the future. The PE ratio is incredibly cheap. It's almost too cheap. Sometimes I get a little bit nervous looking at PE ratios when they are in the low single digits or the mid single digits like this, because I start asking myself, okay, what am I missing, right? You kind of feel like the old phrase that if you don't know who the sucker is at the poker table, then it's probably you. So that is something that we'd want to maybe look into a little bit more. ROE is terrible. Debt to equity probably through the roof. They're not even generating a number. And then the beta is pretty wild, which we do find quite a bit with technology companies. So, I would say that I'm still mixed. I really like this portion of the conversation. That is excellent. We like looking for those situations where we find big dividend yielders with big dividend growth. It gives us a sense that the board of directors is serious about being generous with profit sharing mechanism that is known as dividend payments. In terms of looking at some other resources now, let's go over here, since we had Morningstar pulled up from Eva's question. Let's look at it over here as well, and just kind of get a sense, because remember, Morningstar is more of a value-oriented shop. It's not necessarily a dividend growth investing shop, so they might have a more appealing view towards it. Let's just take a peek here. Okay, now as we pull this up, you can see they offer them a 3-star ranking. So I was kind of thinking maybe in my head maybe they'd get to 4. No, they're at 3, which I guess is a little bit above average on a 1 to 5 scale. But it's not considered a superior value. And the stock has bounced here recently, as we said, due to that merger news. So I'm sure that probably impacted it to a degree. They say on this one they don't have an economic moat there either. So again, this one I'm probably a little bit less surprised about than Con Ed, but I would say that I'm actually surprised on both of them. Less or so on this one, but it's interesting that neither one of these have a competitive advantage according to Morningstar. Let's kind of get a sense of why they view it that way. Come on down here to the economic moat, and it says we do not assign HP an economic moat. Although HP has rebounded from a down fiscal 2016, we cannot assume the company will substantiate long-term advantages in the mature markets of computing and printing. Spurts of growth may be realized through HP's focused initiatives that include devices as a service, or DAAS, premium and gaming computers, 3D printing, A3 printing, However, the headwinds facing HP's core business segments could offset any prospective growth. Their two main their two main business segments are personal systems and printing. So anyway, it just sounds like it's one of those situations where this is an old school tech name that is bleeding off opportunity because of the digitization of our world around us, and people needing less hardware, less printing capabilities if so many things are digital, etc. And while they are doing their best to pivot, it's hard for them to do it. It's kind of a similar story to IBM in that case, right? IBM is kind of going through the same struggles right now, an old line tech company that recognizes their old way of doing things is going the way of the dodo bird, and they need to pivot. The question is, how quickly can they pivot, and will their new business ventures be able to offset any losses they have from their cash cow business that they used to dominate? So that's kind of where things stand there from Hewlett Packard's perspective. So having looked at all of that, I'm kind of in the same place. It's interesting enough. I think it deserves a conversation because there aren't a lot of great technology companies out there from a dividend perspective. But I do kind of walk away being just less enthusiastic about the business model itself. It just seems like there may be better opportunities out there. So that one I would call myself a fence sitter on. It's a tricky one in my head. I think there are way better businesses out there, but the fact that this one's at a pretty interesting price, it might be kind of one of those where you have it in the middle a little bit. So anyway, call me still hesitant around Hewlett Packard for the long term. Obviously, in the short term, if there's a 20% bounce tomorrow on the buyout news or something like that, that's a completely different ballgame there. But in terms of long-term prospects of businesses I want to be a business owner of, I still have hesitations around Hewlett Packard personally. Okay, I'll wish you all the best with whatever you decide, because of course I can be wrong just as much as anybody else. All right, moving right along here. Dan says, can you discuss your process of selecting the 3 stocks for the swing trading class in light of the ConocoPhillips change yesterday? Actually, it's not ConocoPhillips anymore, is it? It's just Conoco. When is a stock value versus quality versus momentum? Okay, so let me kind of explain kind of what I do for that particular class. And that class actually requires more prep from me than my other classes, and it's kind of weird to think that for some reason, because I myself don't consider myself a swing trader, right? I myself consider myself a dividend growth investor. So it's a bit peculiar that the class where I probably have less actual association with from an investing perspective is the class that I need to put in the most prep on. But it is what it is. Shorter term trading does need more babysitting. So I suppose from that perspective, it makes a bit of sense. And that is what that class is about. The Wednesday swing trading class is an active trading class where we don't anticipate being in stocks for any more than a few weeks. So as we go forward, let's go ahead and pull up the Strategy Lab area of our website. And remember that if you don't know how to get this on our website, sometimes that people forget how to get here or there. Just hover your mouse over the blog and click on Strategy Lab. All right. So as I've got this pulled up, oh, and the other thing I should mention before I get started here. Thank you for saying that, Joe. I actually saw that Ken said that yesterday on Twitter as well, and it's nice to hear that, quite frankly, because again, when you put an effort into something, you want to make sure that it is a good experience for those that you are serving. And so while I am not the most enthusiastic swing trader on planet Earth, I do hope to do my job adequately enough to give those of you that want to be swing traders some really interesting things to think about and some additional knowledge to make you more confident in whatever your endeavors are. So I appreciate you saying that. Over here, I wanted to bring up real quick that Van was asking a very similar question. So what I'm going to try to do here is I'm going to try to tackle both Dan and Van's questions together. So Van was asking us on the steps to do that as well right there. And he says that he understands where the factor's coming from each week. So I'll explain that as well anyway, just because Dan's kind of asking about that full approach. Real quick here, looking for candidates, and then when will that trading plan become available? The trading plan itself is still the same, Van, so I can answer that portion of the question fairly easily. So let's just start with that. What I do need to do, which is actually written on a note here, believe it or not, at my workstation. So I have a to-do list of lots and lots of things on it. One of them is to go in and change the name of the trading plan. The trading plan still says Strategy Lab. Technically, that should say Factor-Based Swing Trading. But the plan is still accurate, so I don't know if there's any confusion there. But remember, we changed the name of the class from a business perspective here at Market Scholars, because when we started selling our services to outsiders beyond all of you that were our kind of beta users initially, we kind of realized that if you told somebody that, hey, you get these 8 different classes and one of them is Strategy Lab, like the average person on the street has no clue what Strategy Lab is or what it means, right? It wouldn't be an appealing sales element whatsoever if you said, hey, guess what? You get access to Strategy Lab. Okay, never heard of it. So we decided to change the name of the class to Factor-Based Swing Trading. That is a much more well-known concept from a general perspective. Those of you that have been with me for a number of years, of course, have heard of the term Strategy Lab, because that's kind of been my, pet project for many years. But the average person on the street that we would ultimately be selling our services to from Market Scholars' perspective would have no clue what Strategy Lab was. So we made the decision, let's change the name of Strategy Lab class to the Factor-Based Swing Trading class. And that way, when somebody's kind of looking at our offerings at Market Scholars, they say, oh, okay, it looks like they offer a swing trading class. That would make sense in their head. Looking at Strategy Lab, that would not make sense in their head. So just think of that as a cosmetic change more than anything else. What we're doing is still the same, right? We're selecting stocks from the holdings that the class is focusing on that week. Now remember, we focus on 2 different areas because we do both bullish and bearish swing trading. Stocks that are liquid, if planning to short the stock, it needs to be considered easy to borrow, so we're still doing that. Stocks that have appeared to trade in somewhat predictable patterns in the past, so we're still doing that. And then it talks about the hold method and looking for bullish setups and different things like that. And it talks about risking 0.5% of our account and our reward to risk ratio of 1.0. So we're still doing all of that type of stuff. And then I try to go down here in the additional notes to kind of explain things like the bullish and bearish divergences that you guys will hear me talk about when we use that blue line on the market forecast. So some of that stuff gets a little bit lost in the class, admittedly, because remember, in the class, we have plus subscribers in there. Plus subscribers, just so you guys are aware, don't have access to anything on our website other than like the market forecast forum. So in other words, plus subscribers don't have access to the trading plans. You guys do. You guys are all premium members because only premium members can be in this question and answer session. So I can show you this without any fear in this class. You guys are all entitled to see this information. I don't regularly bring up the trading plans in the class itself because there are people that attend that class that are just testing us for a month there, and they could just easily pilfer all of our information if they wanted to. So I'm a little bit more hesitant to do that. So just a little bit of background there, Van, why there might be some confusion. But yes, largely we still practice the spirit of this plan here. It's just that I need to go in there and actually change the name of the plan from Strategy Lab to Factor-Based Swing Trading. Okay, so with that part out of the way, let's now talk about the initial question, which is how do I go about that process? So effectively, what I'm doing, on Tuesday night after the market closes, I pull up the Thinkorswim platform and I come over here to chart 3C, the factor comparison chart. By default, this chart should be 1 month daily, which it is, as you can see up here. And I take my screenshot for the blog that I know I'll be posting the next morning. And in the meantime, I'm going to recognize, okay, what are the leading and the lagging factors at that particular time? You can see that the leading factor is value. The lagging factor is low volatility, but that's just right now. Remember, this is a rolling 1 month basis. So, a week later, you might see flip-flop. In fact, we did see some flip-flop this week. We saw momentum overtake dividend yield. The prior week, it was not the case. So there was a crossover that took place right there, as you can see when that green line went above the orange line in the prior week. So we didn't have any changes on the top or the bottom, but we had a little bit of change there in the middle. So each week I'm looking at, okay, what is the leading factor from a 1-month basis? What is the lagging factor from a 1-month basis? Once I've made that determination, then I'm going to go in and start looking for trade setups. And the process we use for that particular class is we look for 2 different bullish trade setups and 1 bearish trade setup. The 2 bullish trade setups are going to be stocks that are owned by the value funds that make up this line up here. The stocks that we trade from a bearish perspective, or at least look at from a bearish perspective, which, by the way, I saw that Mondelez trade that you guys voted upon yesterday was down pretty nicely today, so great job there. Looks like we're so far so good. Some profits on that one. So remember, we can trade bearishly in that class, and that's a reminder to those of you that don't attend that swing trading class. That's really the only class that I teach from a trading room perspective where we can be bearish on stocks, right? In my other classes, dividend growth investing, we don't short stocks, and we don't do that in the trend trading class either. So anyway, if you guys want to practice getting bearish and profiting when stocks fall as opposed to when they rise, I would encourage you to attend my Wednesday factor-based swing trading class. So from the bearish side of the equation, we're looking at what is the worst performing factor over that 1-month time period. In this case, it's low volatility. So I'm going to be looking for my bearish swing trading setup from the low volatility funds. Now, in order to get those funds, hopefully most of you have recognized that I went out of my way to hyperlink those funds within the blog post each and every week. Therefore, you guys can access the various stocks that are considered value versus quality versus, all these other factors that we use. So let's have that conversation now after having known this process of looking at it from a 1-month basis. The other thing I'd point out real quick before we leave here, I try to mention this each week, but just in case some of you don't attend that class, this is a really unique chart here, and I have to credit Justin Rogers for sharing this idea with me. I changed a few things along the way in it, but it was really his concept that was holding true on this one when he thought about the idea of blending them together. It was a really good idea, because I think a lot of us are familiar with normal comparison charts where you see these kind of line graphs like this, but each one of the lines represents only one security. This is a unique chart because this value line up here that you see actually represents 4 different securities. It represents the 4 value funds that we use in the Strategy Lab tool. So remember, the class name is Factor-Based Swing Trading. The tool that we use in this class is called Strategy Lab. So the value line here actually represents 4 different securities that are blended together and averaged out to make one line. And that holds true for all of these lines that you see here. All right, so back on over here now to the Strategy Lab post that I put up here yesterday. There is that screenshot in the background that you can always click on if you want to see it bigger. And then down below here, in kind of the more meat of the post, you'll see additional information about the individual securities from an ETF, individual ETF perspective and how they all stack up, and we have that conversation in class as well. But down below here is what I wanted to specifically point out for Dan or anybody else that wants to go through this process. You can see each of the 4 funds that I'm going to use for the Strategy Lab project. So in the case of value, since we're having that conversation, the 4 funds that I'm using are VLUE, FVAL, SPVU, and VFVA. And those are these 4 that you see kind of in the blue area up here in the table as well. The BlackRock one, as you can see over here, is VLUE. The Fidelity one is FVAL, and so on and so forth. But what I wanted to point out is that these are hyperlinked in here. And so this would allow you to go over to the fund family's website to download the holdings yourself if you wanted to. So like if you click on VLUE as just an example. Kathy, I did change those ETFs at the beginning of the year, but this is the first year I've done it from a very structured factor perspective. It was a major hodgepodge, to put it loosely, a year ago, where it was not a structured factor-based approach to Strategy Lab. So yes, I'm more than willing to consider changes. I oftentimes don't like to change things midstream if I can help it. So if I do make any changes, it's typically at the end of the year. So if there are better choices out there, I can certainly look to doing that, but that's a very concise way to look at factor investing. And at this point, I don't have any changes planned for right now, so just be aware of that. But certainly open to the idea, and I have done that indeed in the past. So VLUE, this takes us now over here to the iShares website. And each website, depending upon who the fund family is, has a different way of going about how do you get the various securities that make up that ETF. In this case, you can see there is a portfolio tab up here. So if I click on that, you can then you can look at the top holdings right here. But more important for our purposes, because I don't just look at the top holdings, I'm literally going through hundreds of stocks. That's why the prep time for that class takes so long, is because I'm just rifling through chart after chart after chart after chart. There's hundreds of stocks. So if we look at this, there's a detailed holdings and analytics right down below here that I can click on. That then will bring up a Excel spreadsheet, which is popping up on my other monitor here. But I basically can then, at this point, just take this group of ticker symbols, so highlight all the stocks that make it up. And some of them at the bottom are oftentimes like futures contracts or cash, so I got to be careful on that. So like I would highlight all of these here. Notice that those bottom three are not actual ticker symbols, they're just futures and cash. But once I have that, you can see that there are 149 stocks that make up the value category here, or the value ETF. And there are stocks in there, like you can see in the background, like there's Gap, very well-known company, there's Sprint and Jazz Pharmaceuticals and Dish Network, etc. So those are the types of companies that, in this case, BlackRock considers to be value stocks, right? So I think that was kind of at the crux of the question there for Dan as well, is how do you determine that ConocoPhillips is a value stock? Well, I don't, right? It's not up to me. I am taking my cues from these companies. That's the whole point of keeping it consistent there. So it's not me coming out and saying, well, stock, the other one we looked at was Amcor yesterday. I had never even heard of Amcor before yesterday. And so there's no way I could come up and say, yes, Amcor is a great value right now, right? So it's not me saying that it's a value. It's me just taking the holdings of the value funds themselves, and it's up to BlackRock and Fidelity and Invesco and the others to have their own way of determining what is value and what is not. Now, typical things, in terms of value specifically that, they would look for are just going to be things like, price to book and price to earnings and price to cash flow and price to sales. So, oftentimes they have a very similar approach to one another in terms of the various fund families and how they approach factor investing. But there can be some differences along the way. Maybe one of them uses price to book, one of them doesn't in terms of value. Maybe the momentum funds, one of the fund families will use a look back period of 6 months, and then other one will only use a look back period of 3 months. Quality can have some differences. Maybe one fund family considers a quality stock as one that has a lack of debt, whereas another fund family might view a quality stock as one being a stock with high profitability. So it's up to each one of these fund families to determine, in their eyes, what do they think a value stock is, or a dividend yield stock is, or a momentum stock is. But what I'm doing on the backside is just simply taking their holdings, loading them up into a big watch list into my Thinkorswim platform, and then just rifling through the trades, looking for bounce setups along the way that I can highlight for you guys during class there. So that's kind of the process right there. Yeah, I usually update that, Dan, on Tuesday nights. I don't have the spreadsheet shared on the website. Some of you might recall that maybe about 2 or 3 months ago, there was a period of time where I had the ability to embed a spreadsheet on the website. But what happened was once David loaded up our pricing table, because remember, for the first year plus on Market Scholars, we didn't have a pricing table. I mean, it was kind of like almost like a speakeasy. Like you gotta You got to know a guy to get in, right? It was basically a situation where we wanted to have the first year of our business dedicated to those of you that took a chance on us with the first beta period. Of course, we gave you the $1,000 discount as well because we knew there would be difficulties along the way with technology or what have you. So we wanted to make sure that if we were giving you the $1,000 discount, which normally our prices are $3,000 for 3 years. We gave you the $1,000 discount. Another way to thinking of that is your first year was free. So that's how we kind of, posed it to you guys. And so we wanted to be respectful towards that process. So for the first year of Market Scholars, some random person from the outside couldn't just simply come to our website and sign up for a package. Now, if they had emailed us and different things like that, and we made sure that they were comfortable with, the different things they were getting themselves into with us, we would then sell them a package if they really, really wanted to join us during that first year. But we did not advertise it. You could not go to our website and just sign up for our product at that time. Now that first year is over, David then updated our website with the pricing table where somebody from the outside can come to our website and just sign up for a subscription and pay for it right there on their own without ever talking to us. And in doing so, what happened is the pricing table that he used conflicted with the embedding software that we were using for the spreadsheet. Now, he has a ticket in, but I don't think he's ever heard a concrete answer as to what a resolution will be. But our website is a WordPress website. It's WordPress is used by lots and lots of businesses out there, even large businesses. And David and I don't have any developing skills, right? We're not software developers or anything like that. And so we rely upon others to build out our website. So there are lots and lots of developers out there that make certain things for WordPress websites. They don't all talk to one another because they don't all work for the same company. WordPress is one company, but then you have a whole bunch of outsourced contractors that are building their own products to sell to companies like ours that use WordPress as their baseline website. And unfortunately, the two different companies, one that developed the pricing table and one that developed the embedding software, they did not jive with one another. So ever since we've had that pricing table on our website, we haven't been able to embed spreadsheets. So we're looking at it. In fact, that's another thing on my watch list or my to-do list is to look at alternatives. If that spreadsheet is not going to be allowed to be embedded, then there's not a whole lot that I can do, and I might just have to move on and look for a different company that can do that and that does jive with the pricing table there. So that's kind of the background there. So what I've been doing instead is just putting a screenshot on here because my spreadsheet is just this. There's nothing else to the spreadsheet. It is only this. And that's the spreadsheet that if you were in class yesterday, which it sounds like you were, you saw me share with you. So there's nothing really to the spreadsheet other than just this information right here. So it's not like you're missing out on a whole bunch. I'm putting it right there for you. The benefit of having it on the spreadsheet for my purposes is it then allows me to sort the columns. So, if you wanted to do that, you could fairly easily do that on your own. These columns, by the way, are just coming from the platform. So as an example, let's see here. So here are, give me a second to get something all straightened out here. Okay, so here is basically what I'm doing. It's really easy. It's not like it's not rocket science or anything like that, right? Basically, I've just got this spreadsheet, or not a spreadsheet, but this watch list of Strategy Lab ETFs up here. You can see all of these are the Strategy Lab ETFs I have for the plan. And so if sorting, because for those of you that are not able to see the chats, if you're watching the YouTube version of the recording, Dan is coming back to me now and saying, sorting is a thing. Come on, Brandon, sorting. It's all about sorting. Come on, guys. Sorry, I'm on my Fletch mode right now. It's all ball bearings. All right, so sorting, if that's all you want, then I've got an even better opportunity for you. Boy, that sounded like a sales pitch, didn't it? Rather than using a spreadsheet, just sort in the Thinkorswim platform. So you can see up here, I've got the 1 month, the 3 month, the 6 month, and the 12-month columns right here. So all I'm doing on Tuesdays is I'm bringing this by just, basically highlighting the first one, holding down Shift on my keyboard, and then clicking the last one, which highlights all of them. and then Control C to copy that, and then I'm just boosting that information over to the spreadsheet. So I do it for more aesthetics than anything else because I think it looks cooler for our purposes on the website to be able to have a screenshot of a colorful table like that. But the data itself is exactly coming from here. I'm just doing a copy paste over to the spreadsheet and then just putting this data that I have right here into the spreadsheet. So, you know, you would actually be doing more work than you would need to if you would go through what I do. I do that because, again, it looks better from an aesthetic perspective, but you could save yourself a couple of steps and just load up this. And I can share this probably with you right here too. Let me see. I don't share watch lists all that often, so give me just a second. I always forget where that is. Okay, here it is. So let's share that. There's the shared link. And those of you that are in class right now then could load that up, and that would basically load up these 25. Now you could build this by yourself as well, right? Just, you know, basically one at a time, type them in. But you could also upload that link and it will bring them in there for you. Now in terms of what I'm using here, if that's going to be the next question, these are customized scripts that I have up here in my columns. And so I will show them to you, and I might be able to even put those in the chat here real quick, just in case you guys don't have them. Most of you do by now because these are columns I've used for many, many years. In fact, I have, before I go forward, just in case this brings up another question, because it seems like anytime you go down one step, then it brings up another question, another question, another question. All right, for those of you that are in this class right now, you're all premium members, and therefore you're all entitled to the resources area of our blog. Remember, that is off limits to plus subscribers. So let's go over here to the resource area of the blog and remind you there's a lot of helpful information here. I know sometimes people tend to forget about this part of our website after, you know, signing up with us initially. They set up their charts or what have you, but there's good stuff here. So my position sizing calculator that I use for my swing trading class is there. My trading plans are there. Some historical charts are there, and this is the one that I wanted to reference right here, the TOS watch list custom column tutorial. So in here, I think I actually have the scripts themselves. Yes, I do. So let me get this link to those of you that are in the class as well. And if you ever wanted to set up a custom column using ThinkScript, this tutorial right here will explain how to import a couple of basic ones. And one of those basic ones that I show you as just kind of educational purposes is the 3-month percentage column. So that is one of the 4 that I'm using for the Strategy Lab project. I use a 1 month, a 3 month, a 6 month, and a 12 month. And so 3 months is 1 out of the 4 that you would need. So you could just go and import that link right there that you see into your own platform if you do not already have a 3-month percentage column already established in your platform. Now, the background information beyond that, as far as the details of that specific calculation, the 3-month code, is right down here. And what you're really going to want to pay attention to is the number within the brackets right here. In this case, it says 63 because there are approximately 63 trading days in every 3-month time period. And so you can kind of use that same mentality to create your own 1 month and 6 month and 12 month one to kind of emulate what I'm doing there if you want. So a 1 month look back would be 21 days instead of 63. So you'd basically just swap out that part of the code. And then 126 would be 6 months, and then 252 would be the 1 year, and that's exactly what you'll see me have up here. If I were to go to the 1 month, go to Edit Formula, you'll see I'm using a 21-day look back period there. If we go to the 3 months, you'll see that I'm using 63 look back period there. If you go to the 6 months, you can see that I'm using the 126 look back period right there. And then if you go to 12 months, you can see that I'm using the 252 look back period right there. So that's all there is to it. And that would actually save you steps. That helps, that's even more useful than a spreadsheet in my eyes from your perspective. Is just simply sorting on the platform itself, because then you wouldn't even have to carry that data to the spreadsheet. So that's all I'm doing when I'm going through that process right there. Okay. All right. Yeah, we already talked about the Schwab and Ameritrade merger at the beginning of the class there. Leonard. So if you want to hear my comments and thoughts on that, I'll post the recording of this class here after it's done, and hopefully you'll be able to watch the recording there. But yeah, very interesting news for certain. Thank you for that question, Dan. Hopefully that gave you a bit more insight there as far as my process, and the same goes for Van. Let's go ahead and move on now to Irene's question. And so Irene is asking, if you've previously answered this recently, you can skip my question, but would SJM be a good DGI candidate today? I think it would be, Irene. Now, I admit I get interested in peculiar stocks. I'm usually interested in very boring stocks, and it doesn't get much more boring than peanut butter and jelly. So yes, I personally think SJM is a very interesting candidate here, but admittedly, it hasn't really done much in recent years. And so some of you have bought it, years ago and thought you had high hopes for it, and it really hasn't done much. I can understand where there might be disappointment there. But, given the prospects of a potential market move lower in future years, right? And I'm not saying that's happening now, because I think most of you know my stance. I believe that we are in a bull market that will continue through the rest of this year. But at some point, there will be a market pullback. And when that occurs, I fear that a lot of the hottest stocks in the market will go down the fastest. And so we always have to be mindful of valuations and where things stand, et cetera, et cetera. So as I look at SJM right now, you can see that SJM is at a lower area, right? They're certainly not as low as they were 10 years ago when they were a $53 stock. They're double that. So they've doubled in 10 years. But on the other hand, they've come down 50% off of their top. They were once a $157 company. So this is a stock that kind of finds itself in a meandering zone. And I think if you're looking at this company, in the proper spots, and right now I would say is the proper spot. Again, that's assuming your mindset is a dividend growth investor mindset. There are lots and lots of ways to look at the markets. The approach that we use in the Tuesday class is one of, let's look at yield as our way to establish how much value is available or how little value is available in that company's future potential. And so when this stock comes down here into this blue area, we become more excited, right? And sometimes that works, sometimes it doesn't, right? We have to be mindful of that. But we also have to remember that dividend growth investing is a game of patience. It really is. I know people hear that, they hear me say it, but until you experience it, you don't really feel that, right? You actually do need patience. Target is a great example of this. One of the things that I mentioned on Twitter is that my original students, and we're going way, way, way back. I don't know if Tom Chell is in class today, but he might recall me talking about this, because I remember specifically talking to Tom. For some reason, my memory, latches on to certain moments in time, in a strange way. Sometimes people, a song jogs their memory to where they were at a moment in time when they heard a song. For some reason, for me, it's stocks. When I hear a certain stock, a certain memory hits my mind. Well, we were looking at Target way back in the day when it was, $60 or just a bit less. And Target ultimately had a really nice response. It came all the way up here to, whatever this is, 86. But this stock went all the way back down to these levels, 52, meaning that anybody who had bought over here was disappointed because they saw a very good profit situation evaporate into nothing. They actually ended up seeing all of it evaporate. Now, eventually, it started stabilizing in this area again, just around 60 or a hair below it, and it went on another major ramp higher. Now, again, people who bought here, which some of you in this audience might be there because some of you, haven't been with me as long as Tom Chella has, but some of you have been with me at least since the Invest Tools days. And certainly we were looking at Target during this era right here. And Target went from being below 60 to all the way up here to 89 in this case, an even bigger move than what we saw over here initially. Well, what happened after that? Boom. That thing got annihilated yet again. There's Tom. How you doing? Sometimes I don't know if he's out there. Sometimes he's just lurking in the background. But Tom's a great guy. I got a chance to meet him a couple times in person as well, and I'm proud to say that Tom is not only a client of mine, but a friend of mine as well. He's a very good person. And I enjoyed my time with him and working with him over the years. Well, anyway, Target has, capitulated in this era too. And a lot of that was around, all right, is Target going to make it? Is Target going to be able to compete with Amazon, this, that, and the other thing? And so, again, people's hearts were ripped out as they watched this perfectly good stock go from major profits to potentially giving all of those profits back. And then that started this current run, which has been, nothing short of spectacular because you typically don't see massive, tens of billion-dollar types of companies like this go up basically double in a year, right? This thing was priced at $60 here on Christmas Eve. This thing is $126 right now. That's a double in less than a year. And we've had a few of those. Grainger comes to mind as a stock that was able to pull that off for us. Starbucks was really close. Starbucks, I think, doubled our money in 13 months. So there are some that we can get lucky enough to do that. But I would not have guessed that Target would have been the type of company that would have been able to achieve that. So, I just look at this kind of being flabbergasted more than anything. But the point of me bringing all this up is that Target was in this blue zone more times than not in the last 5 years, meaning that anybody who had any interest whatsoever in buying Target doesn't have an excuse for not owning it today. There are situations where those excuses could be valid because the opportunity was very fleeting. And if you weren't willing to strike on day one, you missed your opportunity. That was not the case with Target. Target, you had opportunity after opportunity after opportunity over and over and over again to buy it if you wanted it. Whether you did or not is anybody's guess. Some of you, I think, did and are probably pretty happy about that. So the reason I'm bringing this up is because it strikes a common theme. Another one of those that did that was T. Rowe Price. T. Rowe Price, back in my InvestTools days, we were buying it over and over and over again as it couldn't get out of the blue area. It just got stuck in that blue area. Same thing happened with Qualcomm. We were buying it over and over and over again because it just got stuck in that blue area. So while we would want to be perfect in our selection of securities and buying them at the perfect time and just watching them immediately bounce for us, we know that's not a realistic outcome. That's just, it's not the reality of the situation. What we try to do is we try to buy where there is a reasonable amount of value that is there to be had, but we don't expect an immediate bounce. There will be times where we're bored stiff watching a company go sideways before it finally emerges to where it should be, which is between the blue and the orange lines, like is the case here with Qualcomm. So I kind of get the sense that is where we're hanging out with Smuckers right now. I don't see a big catalyst to get Smuckers rocket and roll into the upside. It's just not that exciting type of a company. So I'm a little bit nervous that this is turning into one of those situations like a T. Rowe Price and a Target and a Qualcomm, where more times than not in the last 3 years, it's been stuck here in the blue part of the chart. And it just doesn't want to seem to kind of, get some traction to get out of that area. It did over here, but then it fell right back in there, right? And so I don't anticipate that will change anytime soon, yet I remain quite high on Smuckers. I think it is a really good opportunity. I just think that people that buy it may very well have to put up with frustration because the stock is entirely likely to continue to just go sideways here in the near term. But I also believe that this company represents a very interesting value situation. In other words, it's trading at 13 times earnings right now. That's cheap for this company. I know it's a boring business model, but surprisingly, they had higher than average PE ratios back during this era over here. Sometimes you'll find these boring companies that do that. There are companies even today that you could make that claim, like Procter & Gamble, right? Another one of those stocks that we bought over and over again, but now finds itself in this massive trajectory. Well, I would call Procter & Gamble pretty overvalued today. Doesn't mean I'd sell it because that's not what I teach, but I wouldn't buy it is the other thing, right? It's in overvalued territory from a dividend growth investor's perspective, right? If you're a momentum investor, or, swing trader or something like that, it's a different conversation. But I would be fearful buying Procter & Gamble today for the long term. I would not be fearful buying Smuckers today for the long term. So that's the difference. My fear is that if we go into a market in the future where we have a legitimate prolonged bear market, Procter & Gamble is probably going to have to give back a lot of their gains along the way. Whereas I'm more confident that Smucker will be able to hold the line because they don't have the gains to give back. They're already in that process right now of giving back those gains. So I'm more optimistic that Smuckers will be able to retain value in a market pullback, whereas I'm less confident that Procter & Gamble and other stocks that have done really well will be able to make the same claim. So on the whole, I view Smuckers as a very appealing candidate right now. I know others will disagree because it's not the most exciting business model out there, but I just think it's a very high quality company. And by the way, some of you on Twitter that follow me there might have seen, where was that article that I retweeted? There it is. There's my pal, my buddy old pal, Ronald Read. A really, really interesting case study. For those of you that have not had the opportunity to read about Ronald Read, please do so. It will help shape your mind as a long-term investor. But this story is a few years old, so it's not anything new that I'm reporting here. Most of you have heard me tell this story many, many times. But Ronald Read was a janitor in Vermont. I point that out not to make fun of his profession or anything like that. It's just simply I want you to understand this guy made a lot less money in his normal job than most of us in this class right now make at our normal jobs. And so in other words, there's no excuse, right? If he can do it, then others can as well. So you might be wondering, was he a secret genius or something like that? Did he have a special algorithm that allowed him to print cash in the marketplace? No, he used a very basic technique, a technique that we use ourselves. And we just look for high quality businesses that pay dividends, that are attractively priced at the time of purchase, and then just hold for as long as you possibly can. It's pretty straightforward. Now, there are times where he failed, right? General Motors was one of the stocks that went to zero, yet he ended up with $8 million despite having a zero in his portfolio. But the reason this is coming to my mind right now with this conversation is you'll notice right there, when he died, he also had large stakes in J.M. Smucker, CVS Health, and Johnson & Johnson. So Ronald Read saw something he liked out of Smuckers a long time ago. I continue to think it's a high-quality company. It's a very boring company, but one that I think is a very appropriate choice for a dividend growth investor that is just starting their portfolio off today, assuming they have room for additional consumer staples exposure. Okay, so hopefully I'm pretty clear on that. Sometimes I'm wishy-washy because I really don't know, right? This one I'm pretty clear on. I do think it's a good value where it stands right here, and I think it's a safer than average choice for the future. All right, let's go ahead and take a peek here at our next question. I think that was the last one on the original docket. Yes, so let me come on over here to see if we had additional ones coming in since the start of class. Okay, and as we look at Sunita's question now, let's take a peek here. One hour and 23 minutes. So Sunita says, what do you think of Netflix? If you own it, would you get out, or do you feel that you want to get in at this time? Okay. So Sunita, if I'm not mistaken, again, I have a memory when it comes to stocks. If I'm not mistaken, it was a few months ago, you had asked me, would I rather Netflix or Disney? We'd have to go back and check the record on that. But I want to say it was like late summer, you asked me that question. And without hesitation, I told you it was Disney. I gave you the whole sob story of telling you that I once upon a time owned Netflix, and I viewed it as a major mistake that I had ever, thought about getting rid of it. But I did, and that was my mistake, and it was a big one, right? We all make mistakes as investors. That was a critical one because that stock has gone up thousands of percent. It would have been probably a life-changing amount, quite frankly. And so, we use mistakes like that as motivation to get better for the future. So I'm not going to let it break me, but it still stings a bit when thinking about it. So I remember sharing that story with you at the time when you asked me that question. So my attitude hasn't changed much since you last asked me that question. I would still prefer Disney over Netflix for the long term. And in fact, you can see that Disney has had a very nice move since we had that conversation. A lot of it was based off of their earnings announcement here a couple of weeks back, really popped up there. But nonetheless, I still think of Disney as having a clearer path of success going forward from this point than Netflix does. And it's not that I dislike Netflix as a business. I am a client of theirs and have been for a long, long time. In fact, during that conversation a couple of months ago when you asked me this question, I also shared with you that I was one of the guys that I still remember when I moved to Minneapolis. I was sharing with Deborah last night on Twitter that when I moved to Minneapolis right after college, I didn't even have a car. I was a poor boy. And I moved downtown Minneapolis knowing that I would be able to walk to work and different things like that. So I didn't even have a car, so I'd have to, go walk down to the Target and walk several blocks home with all of my groceries in tow. So that was a good workout every week for me. But anyway, when I was living back in Minneapolis, me and my roommates decided, hey, let's get in on this little this thing called Netflix. And I don't know the first I'd ever heard of it. I think that I had never heard of it when I lived in South Dakota. So I'm fairly certain that it was when I moved to Minnesota in the year 2000 that was the first I had ever heard of the company Netflix. But as soon as I heard about it, I was highly intrigued. I'm like, really? They do that? That is awesome. Granted, I grew up in a town of 300 people. When we wanted to rent a movie, we literally had to go to the grocery store. They didn't have a Blockbuster Video or anything like that. And there was this little shelf right next to the checkout area where they had all the gummy candy and different things like that. And, there if you rented a movie, you would put your name on this little card and put it on the place. So everybody in town knew who was renting what movies. It's just ridiculous to kind of think back to those times. But anyway, that was the era I grew up in if I ever wanted to rent a movie growing up in South Dakota. So that I moved to Minnesota, big town, right? Minneapolis, which it's a big city. It's a fun town. I like Minneapolis a lot. So I moved to Minneapolis, and I hear about this idea of they'll send you movies in the mail. Are you kidding me? Yes, let's do this. It was awesome, and I really did love it. It was, I must say, I became an instant devotee to Netflix. I thought the idea was grand. Basically, they would send you these DVDs in the mail, and you would have your little queue, your lineup of movies you want to watch, and as soon as you sent one movie back to them, they would send another one to you. I was like, really? This is an awesome business model, right? This is world-changing stuff in my eyes. Little did I know that is almost the joke of the business today, right? They still do a little bit of the sending out of DVDs and different things like that over at Netflix through the mail, but the vast majority of their revenues and earnings now come from their streaming business and their digital business where there is no physical copy of a movie. But I really did enjoy it, and I've been a Netflix subscriber for the better portion of that entire time. So I'm going on nearly 2 decades of being a client of theirs. So it's not that I don't like Netflix, the company. They changed the world multiple times, I would say. It's really an incredible company, and they really put on notice big-time competitors. In fact, they put a nail in the coffin of Blockbuster Video. If you would have went to somebody in 1985 and said, "Hey, Blockbuster Video is going to go away. It won't even exist. Your kids won't even know what Blockbuster Video is," a lot of people would have laughed at you. But Blockbuster Video didn't pivot fast enough, and Netflix absolutely buried them. And so in a way, you got to admire their ferocity from a business perspective. And I think that Disney and others were scared of them. I really do. And they needed to change quickly, and they needed to make really, really tough decisions as well. Remember, that happens in business. There are times where you need to make tough decisions in the near term in order to save yourself for the long term. And so a lot of these, cush businesses of the traditional media that had been making gobs and gobs of money for decades, all of a sudden got disrupted in a major way. And Netflix is the reason for that. Netflix grew to become a massive force. If we were to look at the market cap, I know Netflix is not necessarily gone on to new all-time highs recently or anything like that, but it still has a massive market cap that a lot of people are surprised about to this day. And it is $135 billion. This is a mega cap company. Netflix.com is a mega cap company. That's another thing that somebody would have looked at you fairly curiously about in 1985. Huh? Netflix? What's the net, right? So business changes. Business changes fast, and you got to be open to that possibility, which is part of the reason why in the world of dividend growth investing, we look for companies that are entrenched in businesses that are less likely to be disrupted. You can't always be perfect on that count, but that is the reason why you find consumer staples making up the biggest portion of the dividend aristocrat list. And you find a relative lack of choices from the technology area because technology gets disrupted all the time. So it's very hard for a company to stay relevant decade after decade after decade and pay out higher and higher amounts of dividends every one of those years along the way as a result. So technology stocks are great for trading, not always the best for investing in. So anyway, in terms of where things stand right now for Netflix, again, I view Disney as having the better opportunity going forward from an investor perspective. Now, your question to me didn't specifically address how you were asking me the question. In other words, I know for certain you're not asking me a dividend growth investing question because Netflix doesn't pay a dividend. But in terms of what other approaches, you didn't specify. So let's kind of look at two different approaches I talk about in my classes. Let's start with a trend trading philosophy first. There we go. Okay. NFLX is the ticker symbol, and I'm using chart 1A, which is the chart that we use for our trend trading class on Mondays. And as you can see here, this would be a big time no for us. It is stuck in the middle of a range, right? It's basically over the last year, its high is 230. I'm sorry, its low is 230, and its high is 386. We are at 309 right now. It's almost dead smack in the middle of the high and the low over the last year. In other words, there is no trend. Or if you call it a trend, you would have to call it a sideways trend, right? Our philosophy as trend traders in my Monday class is looking for evidence of momentum. And while you can maybe make the claim that we've had an up move out of Netflix in the last 5 weeks, which is true, we still have a downtrending 30-week moving average in this case. You notice that red colored line that we have right there. So that presents a possible resistance area here in the near term. So this one is stuck in no man's land right now. From a trend trading perspective, we would not consider it. You can also see down below here, the relative strength is just terrible, right? This thing basically was bumping off of 0%, meaning it was one of the worst stocks in the market during this time period. It has now bounced a little bit, but again, our MO in that Monday class is looking for those stocks that have their relative strength up here near 100%. This one is still in the lower half of the range. So clearly the answer would be not interested from a trend trading perspective in Netflix yet, despite how much I love the company as an actual company, just not as a stock right now. So this is a disruptive business that I would love to be able to talk about in the Monday class. It just does not fit our rules here. It doesn't have 3 green arrows. It's not trading above a rising moving average. It's not in a series of higher highs and higher lows. It doesn't have relative strength. So, nothing from what we see on this chart right here would suggest this is a candidate for that class. And again, it doesn't mean that the stock can't go up. It just means we try to practice a consistent approach to markets in my various classes. This one would be against the rules of what we are trying to do from a consistency perspective. If we look at it from a swing trading perspective now, so let's go over here to chart 3A. We'll take a look at, and she says she's got the answer, but I'll just finish up with my thoughts here real briefly on Netflix. Here it's looking a lot better. That move that we've seen more recently out of Netflix is getting it back to that gold line that we see on the chart. That gold line there, that dotted gold line, is the trajectory of the S&P 500 over this chart's time period, which happens to be 3 months. So this is still a market underperformer right now, but with this rally that Netflix has seen here recently, it's getting closer to being a break-even stock compared to the market. The other thing that we think about is, okay, well, what are our expectations about the market in general going forward? Now, I think the market's still got a little bit of gas in it. I think Netflix is the type of company that could benefit from that, because if a stock market stays robust and animal spirits are alive and well, you want exciting names, more cyclical names. You don't want the boring Smuckers of the world like we were talking about before. You want something like a Netflix. That's supercharged trading there on both the upside and the downside. It cuts both ways. So if you're right and you're buying Netflix in the right moment in time, it can produce outsized gains. But if you're wrong, it can produce outsized losses, and that's where the risk comes in. So from a swing trading perspective, I think it looks a lot better than what it looks like from a trend trading perspective. However, with the swing trading mindset that we use in my class on Wednesdays, we look for bounces, not breakouts. And so this is one that I'd like to keep on my radar now that we've got this nice bullish posture and we're trading above that rising moving average, because remember, we couldn't make that claim over here. This was a falling moving average during that era. We've had enough recent strength where you can make the claim that a little bit of a bottom is being formed here. In fact, I really like the higher lows on this one. The higher highs aren't ideal, but I am a fan of a very clear set of higher lows right there. And that's what you want to see. You want to see a pattern develop, that will continue to carry the stock higher. And that's where we're at. The problem is, from a swing trading perspective, you think in terms of breathe in and breathe out. This has been a big breathe out right here. We want this thing to inhale again and come back down and then, do another support bounce like it did over here. At the time we get the support bounce, assuming we have a bullish posture on the near-term line, I think it could be a very interesting candidate right there. So long-term, I like Disney more than Netflix. Long-term prospects like the next decade or two, I think Disney's content wins out. Short-term, I like the way that Netflix is starting to bounce here, and given my assumptions about a strong market into the year end, if we can get a bounce back down on Netflix in, let's say, the next 2 weeks or so, and then it looks like it's going to do one of these bounces like it did back here off the moving average, I think it could be a very interesting candidate right there. So I think out of all the different classes that I teach, the closest I could get to liking Netflix would be the swing trading class, but that's only after a little bit of a pullback because this thing's gotten really hot here in the last 6 days, up 6 days in a row. So if we can get maybe 2 or 3 days to the downside, reset the gauge, look for a bounce higher, I think there might be something to this story here. So that's my thoughts. Appreciate your question there, Sanita, and I'll wish you all the best. All right, next question comes in from Marcia. All right. And Marcia says, about to lose my patience with IBM. I don't think you're alone there. Good dividend, analysts varied, but lots of debt and just flat. Have held for almost 4 years. Am I too impatient? oh, honey. if all of my students could come to me and say, am I too patient by holding a stock for 4 years? Oh, I admire that a lot. A lot of times people are saying, I'm a long-term investor now, Brandon. I've held that stock for 4 months. High fives, right? 4 years is pretty darn good. Let's put it that way. I would venture to guess there are people in this audience here right now that have not held any stock their entire life for 4 years. So I don't think I would call you too impatient, Marcia. And I tend to agree with you. As much as it is hard for me to utter that, I tend to agree with you. It's been a frustrating experience for IBM. It really has. And we've been through a lot with it because you'll recall that when we first started talking about IBM all those years ago, it was a Warren Buffett pick. That was what kind of inspired confidence in a lot of investors. And it is a reminder that Warren Buffett does not have a crystal ball, right? I admire the guy a lot. I credit the guy for a lot of my knowledge of the markets. But he is not perfect. He's never claimed that he can walk on water. So he gets, there's a target on his back and everybody likes to, chuck a bunch of cheap shots at him because it makes other people feel better when they are just nasty to others. And I don't know why that is. But Buffett's always been clear as day to me. He's never claimed to be some sort of a messiah or anything like that, right? He's not perfect. He's just an average person like you and me. In fact, that's what is appealing to me about him, is that he is an average person. He's not some big wig that hides behind, big walled fences, or, in the fancy high rise of New York City, and, has his own butler and, this, that, and the other thing. He's pretty much an average guy, but he just happens to be an average guy that's one of the 5 richest people on the planet. So, he still lives in the exact same house that he purchased back in the 1960s in Omaha, a quiet neighborhood. In fact, my brother used to live just 2 streets down from him, which is kind of crazy to think about. My brother's not a rich guy, so it's not that he's in some fancy neighborhood. He's just in a normal kind of older part of Omaha. I get a kick out of that. He obviously has the means to live wherever he wants, but he chooses just to be an average Joe that eats his breakfast at McDonald's. So anyway, IBM was one of those picks that Mr. Buffett got himself into a few years ago. He has since gotten himself out of it, and he is looking probably rather prescient for have done so. Let's pull up a longer term chart just so we can set the table here. There you go, Joe, the Oracle of Omaha. Always like that name. Let's see, IBM. Some people call him the Wizard of Wall Street as well. I've always been more fond of the Oracle of Omaha. So as we look at IBM here, you can see this is one of those, right? We talked about Qualcomm here and talked about how it was kind of stuck in the mud as a similar tech stock that pays a dividend that's in the blue area and has been for quite some time. So Qualcomm got, their get out of jail free card. They finally turned a corner and emerged above the blue line. IBM has not yet, and I already talked about IBM a little bit when I was answering the question earlier in the class about Hewlett-Packard. I tend to think of them as old school technology businesses that are bleeding off the kind of the fat portion of their business that they made their name on for years and years and years and years, where they had cash cow businesses, where they realized we are entering a new era. And the question mark is whether they are pivoting fast enough or not. So I would kind of think about IBM and Hewlett-Packard as kind of being in the same territory. For some reason, I think of IBM as slightly higher quality in my own mind than Hewlett-Packard, but we got to be careful there too, because I could have some rose-colored glasses, right? We don't talk about Hewlett-Packard a whole lot in my classes. We have talked about IBM quite a bit. So it's possible that my mind has been warped the wrong way, right? Sometimes that happens. So we have to recognize we're all human. We do make mistakes. It's possible IBM is a mistake. So where we stand right now, it's always tough for me and my personality to give up on a company that I view to be very undervalued. Now, it doesn't mean that will always be the right decision. There will be times where giving up on a stock will be the right choice because there is difficult times in front of those shareholders. What we use as kind of a baseline way of thinking about this is, let's use something that is rational to make our decision. Let's not use something that is emotional to make our decision. And, if you turn on Jim Cramer or something like that and somebody gets you all hot and bothered about a stock, either good or bad, you know what I'm talking about. Those emotions can kind of push you to do, egg-headed things in the stock market. And we want to avoid those whenever possible. And so the way that we kind of approach things from a rational and logical perspective is we ask ourselves a critical question. Is the board of directors satisfied enough with the trajectory of the business to continue paying the dividend at the same rate, or better yet, to continue to raise it? And that's what's the saving grace of IBM. Their stock has gone nowhere. They have a lot of debt, as Marcia mentioned in her question. I would also add that this is the poster child of what I've been kind of talking about recently in other classes when I talk about financial shenanigans, right? We have the conversation in my classes on Tuesdays regularly of, okay, well, did this company buy back shares? Did this company raise their dividend, et cetera? And if the answer to those two questions is yes, then we ask ourselves, well, did they do it because of debt, right? And in some of the company's cases, we come out with a very good answer, which is, hey, this company actually paid down their debt, or at least the debt did not increase throughout the years while they were buying back stock and paying a higher dividend. That is not the case with IBM. IBM is kind of the poster child of, that financial, shuffling of the various chairs, or however you want to say it, shells or whatever. What they've been doing is certainly buying back stock. Now, they did make a big acquisition here more recently where they said they're going to stop buying back stock. So I don't know where they currently stand on that. But over the years, do be aware that they bought back tons of stock. They paid a higher amount of dividends every year along the way. But they were also increasing their debt in a major way along the way as well. And so in a way, they were borrowing more money to finance a higher amount of dividends. Now, they won't tell you that, to your face. They'll say, no, we borrowed money to advance our business projects elsewhere. And, that might be true because money needs to get used to, increase the dividend and to buy factories and buy out other companies. And how can you say, well, this bit of money that we borrowed here was not for paying the higher dividend, it was for buying out this company. So, right, they're not going to come out and say that, but that's one thing that you could infer by their actions. So it makes it a dicier situation. It's true. It is more dangerous. Now, one thing that does continue to linger in the back of my mind is they are on the cusp of becoming an aristocrat. I know I probably shouldn't be influenced by that, but I am who I am, right? I have my own sets of strengths and weaknesses. I'm just like all the rest of you. So that does kind of get knocked around in the back of my mind. And you guys have heard me say, in fact, I said it earlier in this class, there's only one technology stock that's an aristocrat right now, and that's automatic data processing. So IBM has a real shot at becoming an aristocrat in the next couple of years. They did cut their dividend, by the way, for those of you that want to go way back in history. They did cut their dividend back in the early 1990s. Since then, they have gone back on that trajectory to increasing dividends faithfully year in and year out, and now have a dividend increase streak that I think is like 24 years. Let me just double check because I don't want to give you the wrong information. But I know it's nearing aristocrat territory. So let's just pull it up on the spreadsheet here. And yeah, it is. It's 24 years. So again, whether that influences the rest of you or not, I'll leave it up to you, but it is mildly intriguing to me. And I don't know if it should be. I've been known to do arbitrary things from time to time. I can assure you I am not perfect. So, but to me, it's mildly interesting because unless you were lucky enough, like our class was, let me get a graphic out real quick here. Unless you were fortunate enough to have your limit orders set and established on the flash crash day back in 2015, where we were able to buy ADP with a 3% yield when it was trading at $65.31. Unless you were that lucky person, you haven't really been able to buy ADP with a 3% yield in recent years. So the truth of the matter is, some of you might have a goal to add as many dividend aristocrats to your portfolio when they are attractively priced as possible. Kind of the collect the whole set mentality, right? Well, if that is your mindset, and there are people out there that do that, and I don't think it's necessarily a terrible idea, quite frankly. The aristocrat list has been a proven area of the market that has led to outperformance. So if that is your mindset, I'm not even here saying you're doing anything wrong. What I will say is that if that is your mindset, then it is entirely likely that you do not have any technology exposure. Again, assuming you weren't as fortunate as we were to have buying ADP on that one random day in 2015. So from that perspective, I think IBM at least deserves a conversation for dividend growth investors going forward, because some people might look back and say, you know what, I had plenty of opportunities to buy IBM just as they were on the cusp of becoming an aristocrat, and I decided not to, or in this case, I once owned IBM and I decided to sell it. They might end up looking back and regret, thinking to themselves, Now I have no exposure to technology, and I could have had that opportunity. Now, the truth of the matter is, I don't think that's a really great argument right here, right now, because IBM is so far below the blue line that even once they become an aristocrat, and let's say they do go into an uptrend, God forbid if IBM were to ever go in an uptrend again, right? I'm halfway joking there, but halfway not. But let's just say IBM does go into an uptrend, and a year from now it's hitting 52-week highs, and it's being anointed as an aristocrat. Remember, they're likely not going to become an aristocrat this January, but it would be another January after that S&P would make that claim. So, let's say that January of 2021 rolls around and IBM's actually in an uptrend and they're actually hitting 52-week highs. Well, the reality is I could envision them hitting, 160 to 180, but to go all the way up here to 203, boy, unless there's a buyout or a merger or something like that, something truly disruptive that happens, I have a hard time envisioning that would be the case in just a year's time. So the reality of the situation is, by the time IBM is announced to be a dividend aristocrat, there is a very high likelihood in my head that this stock will still be in the blue zone at that time, even if they're in an uptrend in anticipation of becoming an aristocrat. So there is that element to the story. And again, for some of you, it's a non-event because some of you were lucky enough to have bought, Microsoft when we did a few years ago, and you tripled your money there. And some of you were lucky enough to buy Qualcomm and have done very well with Qualcomm. Some of you have bought Texas Instruments and have done very well, which Texas Instruments was one of those other ones that we bought on that day back at $44, right? So the point that I'm driving to is some of you might have other technology exposure where that's not really a big key consideration. But I think a lot of dividend growth investors struggle to find adequate choices within the information technology sector. And IBM still checks a lot of the boxes. So it's really hard because I know where you're coming from, Marcia. And, if you decide to bail, I promise I'm not going to hold it against you because I think you have every right to bail. The stock just really hasn't held up its end of the bargain. And I'm more willing to put up with this type of behavior with a stock like Smucker, right? Smucker is not a disruptive type of a company. You kind of know what you're getting yourself into. You're buying it for the dividend, and if it gives you a little bit of upside appreciation, great. But otherwise, if it just continues to be a sideways type of a stock, no big deal there either because you kind of knew what you're getting yourself into with a stock from a more boring area of the market. IBM is in an exciting area of the market, technology. And technology, for the most part, has done really well in recent years, and IBM has sat out the party. So, with Smucker, I was perfectly fine with the sideways situation. With IBM, I'm less so because of the relative lack of performance versus its sector. So if you do decide to leave IBM, I think it's an acceptable choice given that we've given them a lot of time to perform and they just simply haven't. I generally am under the philosophy of you're going to have to pry the stocks out of my hands. What's the phrase? Pry them out of my cold, dead hands. So, you can probably understand where I am with this conversation. But I will say that for those of you that decide to bail, I think you have every right to do it. I really do. It's one thing if you bail on a company after 4 months. It's another thing if you bail on a company after 4 years, like Marcia has. She put in her time, right? She filled out her punch card when it came to time. She has every right to leave, and still claim that she was a patient, long-term oriented investor. It just is a situation where the stock hasn't worked out, right? And it's just a meandering situation where I don't see it getting corrected here anytime soon. And so a lot to think about with that one. It's not an easy answer. It's really not. I think it's acceptable to either sell it or to buy it. My own mentality would be probably to stay in it, but I can't claim it's going to be the right choice. I have uneasy feelings about IBM, but at the same time, it still has a lot of metrics that are appropriate for dividend growth investors. They still have not cut their dividend, and in fact, they're on the cusp of being designated one of the most elite statuses amongst all dividend investors, which is the Dividend Aristocrat list. So it's a really, really hard conversation here. I can really see it both ways. Generally, when we have these conversations, I lean on the side of the answer of stay in until you see a cut. This is one of the rare circumstances where if you've been in for 4 years and it still hasn't performed the way that you wanted it to originally, and you have a better alternative out there where you could funnel your money into instead of this particular stock, then I think it's acceptable. You've earned that right through your holding period to do so. So those are my thoughts on it, Marsha. I wish you all the best. It's a really, really tricky conversation, though. So think it through as best you can, and if you make a mistake in the end, remember that it won't be your first one or your last one. Mistakes are part of the game as investors. All right, let's see if there's any more questions here. It does look like we had one more question there from Linda. Let's go ahead and put that in our chats. And this is at 1 hour 55 minutes. And Linda says, in the OLTI plan, we don't use protected puts. Why not? A number of reasons. I think they would reduce your results as long-term investors is the key reason. I don't personally use protected puts, and I think anybody who's used protected puts in the last 10 years has become a worse investor as a result of them. So that's the critical part of the conversation. Protected puts cost money, right? And when something costs you money as an investor, it eats into your potential outcome. So you have a decision to make as an investor. When you go into a long-term investing mentality, you have a decision. Do you want to protect your investment or do you not? If you protect your investment, you have to pay for that, just like you have to pay for car insurance, right? They don't give you car insurance for free. If you want to protect your car, you got to pay for it. So it depends on your mindset as an individual. If you're somebody that enjoys paying your insurance policy premiums every quarter or every 6 months, then protected puts might be for you. I can tell you myself, I despise paying the insurance company. I really do. In fact, when you get your mortgage these days, there's a certain threshold. I can't remember the exact numbers. It's been a while now, but there's a certain threshold that the borrowed money, you have to pay additional insurance, mortgage insurance. I'm not talking about home insurance. I'm talking about mortgage insurance until you pay down enough of your house. I'm past that point now, but there was once upon a time I was paying that, and it just drove me nuts. I'm like, so I am literally just paying for nothing, and it was a substantial amount. And it is true. It's I guess the mortgage providers need to protect themselves for somebody that's just going to bail on them in the end. So I get why the business exists, but it drives me nuts as a client or as a consumer of insurance products. I know that I was never going to bail on my mortgage at any point. So for me to be just paying money out of my pocket every single month for nothing to somebody else to pick up on risk of other types of people who are taking on mortgages that are not as responsible as me drove me crazy. So I couldn't wait to get past that part of my pay down process of my house, so I didn't have to pay for nothing. So some of you don't take it as big of an issue as I do. Some of you maybe even enjoy paying insurance premiums. I don't know. I would have a hard time believing somebody actually enjoys that, but maybe some of you are at least more accepting of it than I am. And so you might be the type of person that enjoys paying for protecting your portfolio as well. And so there's not a right or wrong, by the way. What I will say is this. I can confidently say that had you been buying protected puts over the last 10 years, you will have had a much poorer outcome than somebody who is not using protected puts. It's the same conversation. In fact, Linda, I think you're somebody that maybe has used stop losses on your dividend growth investments for the long term as well. It's the same conversation as that, quite frankly. You can use stop losses on dividend growth investments for the long term, but you will have had a poorer experience as a result of that from a performance perspective in the end if you do use stop losses. So, it depends upon your mindset. I am somebody who wants to maximize my opportunity as a long-term investor, and I know that buying of puts will not do that for me. It will maybe help me sleep better at night, but if sleeping better at night is prioritizing your decisions as an investor, then maybe just buying treasury bonds is the better route for you. So where protective puts can help is immediately in front of a bear market. Okay, that sounds pretty reasonable, right? Yeah, sure. Buy puts right in front of a bear market and benefit from that decision. Okay. I think most of you know where I'm going with the conversation. Experts have been telling us for years that we're in a bear market, let alone that we're going into one, right? And it's foolish to think about now because we are almost at all-time highs this very moment in time. Yet for years, people have said, well, we just don't know it yet, but we're actually in a bear market. Or others would maybe not make that claim, but say, oh, the evidence suggests that a bear market has to come next year because we've never had a bull market this long, right? So that is the trickiest part of the conversation. It's the confidence that you have that a bear market is in the works in the near term. If that's the case, then yes, protective puts can help. But the problem with that part of the argument is if you are so convinced that a bear market is just around the corner to the point where you're saying that protective puts would be a useful enterprise for you, why not just sell your stocks, right? I get the argument that, well, if I don't sell my stocks, at least I'm taking in my income. That's true, but I think most of us recognize that when a bear market comes, stock prices will go down much more dramatically than the amount of money you recoup in a dividend payment along the way. So, I go forward as a long-term investor assuming I don't know when a bear market is going to occur. And that has benefited me. I know it may sound like whistling past the graveyard to many of you, but it is an approach that has been more successful than those that have jumped on the bandwagon of a bear market is right around the corner, because that has been stated since probably 2011. I remember we were in that, in 2011, we were having those market in crisis moments. In fact, David will be able to share this information with you better than I can, because I remember we were making this big to-do about it in the summer of 2011, and we had to do these special presentations at night, and David was one of the coaches at that time that was doing these special presentations, because there were so many people out there that thought we were going into a bear market in 2011. Well, I woke up this morning, looked at the calendar, noticed it was 2019. It's 8 years since then where there were legitimate concerns in 2011 that we were going into a bear market. And all along the way, every single year, there are people that claim we are going into a bear market that are just flat out wrong. In fact, the guy that we usually pick on is Stockman. Poor guy has stock in his name, and that's why I keep remembering him. Okay. Let's just go over to, so is his name David Stockman? Yeah, David Stockman. Let's type in David Stockman. Now, this guy has a resume much more impressive than mine. I mean, look at this guy. He doesn't even look like a professional, very astute fella, 73 years old, this, that, the other thing. I mean, he worked for the Office of Management and Budget under President Ronald Reagan. I mean, this guy's got to be the smartest guy on the planet, right? I mean, why would you listen to me if you could listen to a guy with this resume? Of course, I'm being facetious here. If you look at over time, we start looking at some of the videos here. Now, I don't know how they do this on YouTube, so I might not be able to make my point quite as clearly right now as I want to. I wish they would start showing me his the videos with the most hits over time, because I want to go back a few years with this guy, because he's been saying every single year, we're going down, sell everything type of a thing. Even right here, David Stockman, this is back in 2016. This is before the election. This is before people knew that Trump was going to be the president. He says he warns both Trump and Clinton could lead to, what does he say, like a market meltdown. Yes, he always has to emphasize. It's not just like, a little bit of a pullback, right? No, he says a meltdown, right? 25% sell-off. And you could go back further in time and find even older videos than that, and he's had videos every year since then. So this very smart fella that has this very impressive resume, that has, a lot of knowledge about financial markets, goes on to CNBC. They trot him out every single year saying, sell everything. In fact, that was one of my favorite ones that I've shared with people in the past. David Stockman, sell everything. Like, really? Is there ever a time where you literally sell everything? Here it was. November 3rd, 2016, sell everything. And he was very specific on that. He wasn't talking about, hey, just sell your stocks and go into bonds. He was saying sell everything. Get out of the way. This market is going to melt down. Here he is again in 2018 saying, we're talking about a 40% drop. Okay, so let's just go back over here to the stock market in November of 2016 and see where we were trading at that time. It would have been, so it was the first week of November of 2016, but it was right before the election. So it would have been on this candle right here. Now, if you had randomly turned on the TV on that day and saw this really impressive gentleman with this resume working for the President of the United States, the Honorable Ronald Reagan, right? Rest his soul. You would be impressed with this fellow. I'm sure he had very cogent arguments. The bears usually do. They sound smarter than the bulls. There's some really good articles out there that a few folks have done. Morgan, for some reason, his last name's not coming to me right now, but he's a really prolific author on Twitter. Morgan Causel or Fossil, or for some reason it's not at the tip of my mouth. But anyway, he's a great writer. Used to work over at the Motley Fool. Now he's over at some venture capital firm. Morgan Housel. He's written about this, some really good arguments that the bears always sound smarter than the bulls. The bulls always sound like bumbling idiots. Like, yes, we think stocks will go up because stocks have always gone up, right? But in the end, you need to do what's best for your pocketbook, not what sounds the best, right? The bears are always going to have great arguments of why you should get out of the stock market. Had you got out of the stock market right here, you probably would be swearing at David Stockman every time they trot him out on CNBC, because you have missed an epic rally. One of the best years on record we're going through right now, in addition to what happened in 2017, right? Yeah, 2018 was a little choppier, but 2017 was a one-way freight train. If you had not sold your entire portfolio back then, but instead started adding protective puts, your experience would have been miserable that entire time period. Even though there was legitimate good evidence in some people's mind that we were heading for a 25 to 40% crash, and yet what has happened? Oh, the stock market's gone up 50% since then. So that's the main reason, is the portfolio that we are building is a long-term portfolio. We know the risk going into a long-term portfolio, that stocks can and will fall on occasion. We also believe that stocks will go up over the long term, which is the emphasis of that portfolio, the OLTI, for those of you that don't know the initials she chatted in there, options for long-term investors, right? That's what we hope to become. So do some long-term investors hedge their portfolio? Sure, they do, but they probably knowingly give up portions of their performance over time. My approach is one where I would, rather than buy merchandise that I am uncomfortable with enough to have to put protection on it, instead buy merchandise that I'm comfortable with, knowing that a stock can go down without jeopardizing that company's long-term prospects. So you have a choice. Either buy junkier merchandise where you feel the need to buy protective puts, or buy less junky merchandise where you feel comfortable not using the training wheels. I mean, that's kind of another way to kind of think about that, right? When you first start riding a bike, you put the training wheels on. That's what the protective puts are. You might not be confident and comfortable in your ability to ride the bike, so the training wheels are helping you with that. Eventually, once the training wheels come off, you might feel a little bit more confident and comfortable at that time. Again, I'm not here trying to convince you guys to do anything. I need to stress, I'm not your financial advisor. If you feel like using stop losses, or if you feel like using protective puts, be my guest. But I will, tell you just my own philosophy and thought that if you are using stop losses and you are using protective puts in a long-term mentality, your results will be worse than mine. So, it depends. If it helps you sleep at night and you still continue to want to go forward with that philosophy and you want to get worked up by, all of the doomsdayers that you'll hear about, not only on CNBC, but all over, right? You can pick up the newspaper and find somebody that's criticizing the market every single day, yet the stock market goes up. So if you want to get wrapped up in all of that and think to yourself, well, geez, if there was a way that I could just spend more money and give more of my money away to protect my portfolio, well, that's what protective puts can do for you. We are much more interested in the other side of the trade. In other words, we are interested in being the people who sell the puts to the buyers of those puts, right? In that case, we get some sort of a benefit because time decay is working for us. When you're buying protective puts, of course, the downside is that they are low probability trades. And why are they low probability trades? Because time decay is working against you. Flip that around and become the sellers of the puts, we start to become the insurance companies, right? We started the conversation saying how much I despise the insurance companies. Well, it's because they're too profitable. I don't like giving my money to them. Well, this is a scenario where we can turn that upside down. We become the insurance companies the moment we start selling puts. And we benefit from other people's nerves that are out that are oftentimes either unfounded or unwarranted types of nerves that don't necessarily lead to a massive market meltdown. So, that's kind of my takeaway there is protective puts are a great strategy if you know we are on the cusp of a major market meltdown. In all other market scenarios, which is most scenarios, remember market meltdowns only happen maybe once a decade or so. So in all other scenarios, protective puts will be a losing strategy that will cost you money in the end, and it will lead to long-term underperformance. Remember, we don't necessarily mind when stocks go down in our philosophy because we are using the dividends to reinvest in themselves through the DRIP program, right? So when stocks pull back in price like they will in 2008 and other eras, we will continue to buy more and more shares. So I think we have a different philosophy as long-term investors than other market generalists out there that are fearful that a stock market crash is just around the corner. For them, where they don't really get the benefit of buying more and more companies at cheaper and cheaper prices the way that we would if we're using a DRIP, then it might make a bit more sense for them to constantly be buying puts on their portfolio. But I am fairly confident in saying their performance will more times than not be worse, and on the whole be worse. Even though their performance will be better specifically in the bear market, the money that they make in the bear market will not offset all of the losses or lack of profits that they are giving away by buying puts in other eras. Okay, so that's my answer there for you. Obviously, I don't profess to be an options guru or anything like that, so I would encourage you to ask David Settle that question as well. He might very well have a completely different response than me, and I would encourage you to follow his suggestions more so than mine, given his interest in options more than mine. But that is my general philosophy there, and it is mostly directed around a long-term orientation in the market and becoming business owners in good times and bads going forward. Okay? All right, guys, I appreciate you sticking around through to the bitter end here. That was the last question of the day. Thank you for that question, Linda, and everybody else who asked questions today. Remember that David will be doing the market outlook later on here today. I will be posting the sector selector tomorrow night. Appreciate those retweets as always. Thank you for being part of this classroom experience here today. I'll wish you all the best of success on your trades and your investments. Goodbye for now.